Silver traders, listen up. FXLeaders just put $100 silver back on the map right after a 40% one-day crash that scared half the market out. And they're doing it with real levels, real catalysts, and real industrial demand. Not hopium. I'm OG John AG. And in this video, we're going to break this down properly. What actually happened in that $121 to $64 massacre? Why the 50-day and 200-day moving averages on silver just acted like a trampoline? How Trump's new 15% global tariff, Iran tensions, dollar weakness, and Shanghai premiums all plug into the same $100 target, and what levels 64, 69, 87, 100, 117, 1 and 21 really mean for your next 6 to 12 months. Segment 1, the $121 blow-off and the 40% execution. Let's rewind the tape before we look forward. According to FXLeaders, silver didn't just grind higher into 2026, it exploded. The metal ran well above $120, pushed by aggressive speculative positioning, momentum buying as silver outperformed. Strong narratives around industrial demand and tight supply. That last part matters. The story, deficits, solar, EVs, tight physical, was real. But the positioning, leverage, crowded longs went too far, too fast. Then came the hit. In the final days of January 2026, silver suffered one of the steepest one-day declines in its history. Price plunged more than 40%, collapsing from the 120s to below $64 intraday. FXLeaders is blunt about what that was, a violent deleveraging event. Forced liquidations across COMEX futures, options positions, leveraged ETPs, and structured products. This wasn't rational repricing of supply and demand. It was margin clerks, risk systems, auto-liquidation algorithms, all hitting the same market at the same time. The key question is, did that crash destroy the structural bull, or did it flush out the worst leverage and reset the board? FXLeaders is firmly in the second camp. Segment 2, what survived the crash, the demand and deficit story. To answer that, you have to look at what didn't change during the panic. FXLeaders makes this very clear. Industrial demand did not go away. Silver is not just a fear metal. It's a critical industrial input for solar panels, electric vehicles, electronics and 5G, power grid and electrification. None of those trends reversed because silver had a bad day on COMEX. Solar remains a core anchor. The article explicitly points to solar energy as a major underlying driver. Governments are still pushing energy transition. Panel manufacturers still need significant silver loadings. Physical tightness didn't magically vanish. FXLeaders notes reports of elevated physical premiums in Shanghai even after the crash. Premiums don't spike in a market drowning in metal. They spike when spot price is out of line with real-world availability. So structurally, the backdrop is still multi-year supply deficits, real industrial pull, signs of tightness in key hubs like Shanghai. The crash wiped out leverage, not solar panels. Segment 3, Tariffs 2.0. Why trade chaos is now silver's friend now layer in the new macro fuel. Tariffs. FXLeaders walks through it. The U.S. Supreme Court ruled against certain country-specific tariffs, effectively striking down the legal foundation of part of Trump's earlier trade regime. Instead of backing off, the administration responded over the weekend with a new 15% global tariff on imports under a different legal authority. 3 silver implications. Fresh trade uncertainty. When tariff rules change like this, it injects confusion into global supply chains. Corporations and governments start to hedge, financially, with futures and options, physically, by stockpiling key inputs. Dollar softness. FXLeaders notes the U.S. dollar has been under pressure the last 2 sessions as markets digest this new tariff shock. A weaker dollar makes dollar-priced commodities like silver cheaper in local terms for non-U.S. buyers. That tends to boost demand and support price. Macro story reinforcement trade wars and tariff uncertainty are not strong dollar, low inflation stories. They are fragmentation, cost, and risk stories, all of which tend to push investors toward hard assets. So right after a 40% crash washed out hot money, the policy backdrop shifted to one of the most favorable combinations silver can get: trade chaos, dollar weakness, higher global hedging demand. Segment 4, Iran. Geopolitical premium comes back on. On top of tariffs, FXLeaders points to the other classic metals driver, geopolitics. They highlight rising tensions between the U.S. and Iran, adding a risk premium back into global markets. How that plays into silver. Historically, spikes in Middle East tension push oil higher, raise fears about shipping disruptions, energy prices, and broader conflict, trigger flows into safe havens like gold, and increasingly, silver. FXLeaders says explicitly, the combination of trade uncertainty and geopolitical risk revived safe haven demand, and silver climbed into the new week on that bid. So you have a market that was already structurally tight and overlevered, a crash that wiped leverage, then a tariff shock and Iran tension that pushed capital back into metals immediately. That's not what you see at the end of a bull. That's what you see in the middle of a volatile bull. Segment 5, the technical skeleton, 64, 69, 87, 100, 117, 121. Now let's slow down and mark the key levels FXLeaders gives you. According to their charts, crash low, silver briefed dipped below $64 on the panic day. That intraday low is now a major structural support. The market remembers it. First support above the abyss. Around $69, a horizontal level aligned with previous structure. Current zone. Price has rebounded to above $87 at the time of writing, with Monday seeing gains around 2% intraday. Immediate resistance. The psychological and technical barrier at $100. Upper resistance band, the blow-off region between $117 and $121 where the last rally stalled and reversed. On moving averages, the violent sell-off was contained by the 50-day and 200-day simple moving averages on the H4 timeframe. On the weekly chart, the 20-week SMA also acted as support. FXLeaders interpretation. Those moving averages absorbed the downside pressure and then served as launch pads for the latest rebound. So your map looks like this. Downside, first line of defense, 69. Last line, 64. Upside, tactical target, $100. Beyond that, $117, $121 from the last spike. That's a clear battlefield, not guesswork. Segment 6, CME and China. How the crash was amplified and then cleaned up. FXLeaders doesn't ignore the plumbing. They call out two important policy reactions that shaped the crash and its aftermath. CME margin hikes on COMEX. At the height of the volatility, CME raised margin requirements for gold and silver futures. This forced traders to post more capital or close or reduce positions. In a market already under stress, that triggered additional liquidations and made the drop deeper. China's temporary suspension of commodity-linked funds, Chinese authorities restricted trading in certain commodity-linked ETFs, funds to dampen volatility. That reduced speculative buying power on the one hand, but also removed some marginal support during the cascade, worsening the immediate crash. FXLeaders' conclusion. Both sets of actions hurt in the moment, but they likely reduced speculative froth and created a healthier base for the rebound we're seeing now. In other words, the system did what it always does. Smash first, stabilize later. The key thing is, after the smash and the emergency breaks, silver did not stay pinned at 64. It reacted by bouncing sharply into the mid-80s and holding. That's not a dead market. That's a wounded bull getting back up. Segment 7, the macro calendar, data that steers the next few candles. FXLeaders lists this week's macro calendar as important short-term drivers. US PPI, Producer Price Index. If PPI comes in hot, it reinforces inflation stickiness, may delay Fed cuts, can pressure metals short-term. If PPI is cool, it supports disinflation narratives, easier for Fed to signal cuts, supportive for gold and silver. US consumer confidence, weak confidence, risk of slower growth, can favor safe haven flows. Strong confidence, Goldilocks optimism, may shift some flows back into equities temporarily. Weekly jobless claims, rising claims, labor cooling, adds to rate cut case, can help metals. Very low claims, overheated economy narrative may weigh on metals near term. PBOC lending rate decision, a cut or dovish signal from China's central bank, support for growth in industrial demand, positive for silver's industrial side, a surprise hawkish stance, marginal headwind, but unlikely in current conditions. FXLeaders treats these as noise around the signal. They can push silver a few dollars up or down. They do not erase the deeper tariff, geopolitical, and industrial framework. For trading the next week, though, you watch both structural drivers and these calendar hits that trigger squeezes in either direction. Segment 8, Shanghai, premiums, and the second opinion on price. One of the most important confirmations is what's happening outside Western futures. FXLeaders mentions higher physical premiums in Shanghai, indicating robust real-world demand even after the crash. Why does that matter? Because Shanghai is closer to the manufacturing base for electronics, solar, and industrial silver use, less dominated by Western macro speculation. When Shanghai premiums are elevated, it's a sign that real buyers, manufacturers, fabricators, investors, are willing to pay above international spot to secure ounces. In a bullion bull, you want three things to align: paper price trend, higher highs, higher lows. Positioning, not so frothy that every move is a liquidation risk. Physical signals, premiums, tightness, delivery behavior confirming that real demand backs the move. Right now, post-crash, trend, recovering, positioning, flushed a lot of leverage. Physical. Shanghai premiums suggest persistent tightness. That's exactly the mix FXLeaders is responding to with their $100 retest call. Segment 9, why $100 is a retest, not a fantasy. Let's talk about that $100 figure clearly. FXLeaders logic. Silver has already been above $100 in this cycle. The structure that got it there, deficits, industrial demand, risk hedging, is still in place. What failed was the hyper-leveraged, late-stage chase into 120 plus. From here, with leverage reduced, macro drivers still supportive, tariffs, geopolitics, dollar, technical structure intact, 50, 200-day SMAs, and 20-week SMA holding, they see a path where silver can first rebuild toward the 90s, then retest $100 as the next big level. $100 in this framing is a logical extension of the current move, not a moonshot requiring some brand new story. The brand new story, like a major Iran conflict or a deeper tariff war, is what would be needed to push past 100 toward 117, 121, and beyond. So mentally separate. Base case, crash, reset, rebuild, $100 retest in this cycle. Upside case, crash, reset, escalation in geopolitics or macro stress, $117, $121, and potentially higher. FXLeaders is putting $100 in the base case bucket, not the hype bucket. Segment 10, how a serious trader or stacker uses this. If you're serious and not just doom scrolling charts, here's how this FXLeaders piece helps you. From their own analysis, know your levels. Support, $69, then $64 as the line in the sand from the crash low. Resistance, $100 as the next big battle, then $117, $121. Moving averages, watch the 50-day, 200-day on H4 and the 20-week for clues on trend health. Respect the volatility. A 40% one-day crash tells you this instrument can hurt you if you're over-levered. FXLeaders explicitly calls silver highly volatile, with the crash exposing the risks of excessive leverage. Separate structure from noise structure, trade and tariff uncertainty, rising geopolitical risk, dollar pressure, strong industrial demand, Shanghai premiums, noise, individual data points, PPI, confidence, claims, day-to-day headlines. Align your vehicle with your time frame. If you're trading short-term with leverage, this environment is opportunity and danger. If you're stacking physical for a multi-year thesis, this article is another institutional confirmation that the crash was a reset. The drivers for higher prices remain. $100 is not outlandish in that context. FXLeaders doesn't tell you buy now or miss out. They tell you the conditions for a renewed advance are in place. The path to 100 plus is open again if those conditions persist. You've been watching John AG here, and I'm OG John AG. If this longer breakdown helped you see why FXLeaders putting $100 back on the table after a 40% crash is about structure, not hopium, hit like so this doesn't get buried, smash subscribe with all notifications on, and drop a comment, $64 to $120 to $64 to $100. Where are we in the cycle? Tell me whether you think this is just a dead cat bounce or the mid-cycle reset before the next real leg higher, and why. Because on this channel, we don't just read forecasts. We break down who, what, and which forces actually have the power to push silver to those levels.